Welcome back to the channel, everybody. In today's video, I got another tier list video for you guys. Now look, 2025 is coming to an end. 2026, it's in a few weeks from now. So for this investing video, I've kind of done a video similar to this before, but we're going to be looking at what I believe are the best investment strategies and best investments for 2026 and long-term investing. All my opinions in this video and how I rank these are going to be based on what I believe is going to perform good in 2026 and what I believe is going to be great investments for your long-term future. Because look, where I'm coming from, I'm 25, right? I'm in my mid-20s, and I got a long time left of investing for me. So if you're at a different age from me, you're younger, you're older, whatever it might be, you might have different opinions. I'd love to hear them in the comments below. But let's get into this video. Let's start breaking down these different investment strategies and different investments that I believe are great for long-term investing and 2026. Now, also to preface it, S tier is going to be your best. F tier is going to be your worst. I'll label those for you guys too to make it clear, but let's get into the video here and start things off. All right, so first up on the list is going to be auto investments. Now, this is more so a strategy rather than an actual thing you invest your money in, but basically auto investing is exactly what it sounds like. You set up automatic contributions into your investment account, whether that's weekly, bi-weekly, or monthly, and the money gets invested without you having to think about it. There's no timing the market involved, there's no guessing, and the best part is a lot of your emotions stay out of automatic investing. Now, the biggest pro here is consistency. A lot of people do not fail at investing because they pick bad assets. They fail because they're extremely inconsistent. So auto investing removes that problem completely, and it turns investing more so into a habit rather than a decision. Another big advantage is that, it kind of naturally uses dollar cost averaging. So you're going to buying in during the highs and buying in during the lows and kind of everything in between. And it's also a massive mental win because you're not checking the market every day, you're not stressing about red days, and you're not trying to kind of outsmart every other investor. So the downsides with automatic investing, though, is that it can definitely feel boring, right? If you're someone who wants to be more hands-on when it comes to your investing and you want to adjust things, auto investing can definitely feel a little bit passive for some people. And the other biggest con with auto investing is cash flow. If you set it a little too aggressively and your income isn't stable, you might end up having to pause or pull money out or just stop your investments in general, which kind of defeats the purpose. But overall, for the average person, especially for beginners or anyone with a full-time job and decent cash flow management, auto investing is one of the most effective strategies out there, and it's my favorite strategy for myself to follow because it removes emotion and it kind of builds that habitual investing over time. So with that being said, for me, auto investing is an S tier investment strategy. It's something that I think every single person, if you want to get into investing and you want to make it extremely, extremely easy for yourself, start automatic investing today, tomorrow, whatever you want to do. It just makes the overall process of investing very stress-free and very easy. Next up on the tier list is going to be bonds. Now, bonds is definitely one of those things that for most people is an extremely boring topic, but it's important to understand what role bonds play in the investing world. Just at a super basic level, when you buy a bond, you're basically lending money to a government or a company, and in return, they pay you interest over time. And at the end of the bond's term, you get your original money back. So instead of owning part of a company like a stock, you're basically acting as a lender. Now, the biggest pro with bonds is stability. They're generally much less volatile than your traditional stocks and especially your cryptocurrency, which means you're not seeing huge swings up, but you're also not seeing huge swings down. And that's why bonds are often used to smooth out portfolios or kind of as a hedge against inflation for a lot of older people. Another benefit is predictable income. Bonds pay interest on a regular schedule, which can be useful if you're someone who values steady cash flow or wants less uncertainty with your investments. Now, the downside of bonds is that, this is the biggest one, is you got lower long-term returns. Over long periods of time, bonds almost always underperform the stock market. So if you're young and you're focused on growth, being too heavy in bonds can really slow down a lot of your wealth building. And there's also inflation risk. If inflation runs a little bit higher than the interest your bond is paying, your purchasing power is actually going backwards, even though your account balance looks stable. And so bonds can be a little sensitive to interest rate changing. So when rates go up, bond prices usually go down, which surprises a lot of people who think bonds are quote unquote risk free. So at the end of the day, in my opinion, bonds are really for those people that that are a little bit closer to retirement, or for anyone who wants to reduce volatility. Now, once again, I'm a younger investor, so for me, something like bonds, in my opinion, is just going to be in the C tier category. It's not something I actively invest my money into. And in my opinion, if you're under the age of, later 50s or 60s, I really wouldn't get into bonds too much. I don't really think they're going to perform that well in 2026, and I don't really see it as a good long-term investment for younger investors. Next up on the list is going to be covered calls. Now, this is one of those ones that I overcomplicated when I first got into investing, but the principle is pretty simple. A covered call is when you own shares of a stock, usually 100 shares, and you sell a call option against those shares. So in exchange, you collect a premium up front, and that premium is yours to keep no matter what happens. Now, the main appeal here that everyone's going to tell you is income. Covered calls let you generate cash flow from stocks you already own, which is why a lot of people like this strategy in sideways or slow-moving markets. Now, another pro is that it can slightly reduce downside risk. The premium you collect acts as a small buffer if that stock drops. So while it doesn't protect you from big losses, it does soften the blow. Now, the big trade-off, right, is that it can definitely cap your upside. If the stock shoots way past your strike price, your shares get called away and you miss out on those further gains. Now, there's also a big skill and timing element. Covered calls are not for beginners at all. I've been investing for almost 2 years now, and I do not touch covered calls. So you need to understand strike prices, expiration dates, and know how volatile that specific stock is. If you don't, it is easy to sell calls a little too aggressively and end up limiting your long-term returns. Another downside is that it works best when you already have a decent sized portfolio. You need at least 100 shares of that stock, which can be big capital requirement depending on the company. If you're thinking about buying Microsoft, 100 shares is a lot of money. So covered calls make the most sense for investors who already own stocks they're comfortable for holding long term and who are okay trading some upside for consistent income. At the end of the day, for long-term investing, for beginners, and for 2026, I'm going to put covered calls in C tier. I know there's probably people who have made decent amounts of money using covered calls, but once again, for long-term investing, for easy, stress-free investing, I stay away from stuff like covered calls. Next on the list is dividend investing. Now, this is when you focus on stocks or funds that pay you cash regularly. Now, this is usually in the form of quarterly payments just for owning the stock. So it's basically getting paid while you hold your investments. Now, the biggest pro, just like covered calls, is consistent income. Dividends can create steady cash flow, and when you reinvest those dividend payments, they can compound over time without really you doing much extra work. Another plus is stability. Dividend companies are often more established, for example, Coca-Cola, which can make portfolios feel less volatile compared to pure growth stocks. The downside is slower growth over time. High dividend stocks usually don't grow as fast as growth-focused companies. So if you're young and you're chasing kind of maximum returns, this can definitely hold you back a little bit. Now, there's always kind of that mindset trap as well. People sometimes chase dividends instead of total returns. So even when the underlying investment isn't great, a lot of people tell themselves, well, it's worth it because I'm getting a dividend payout, which can be a trap in itself. So dividend investing makes a lot more sense later in your investing journey. I would say if you're a young person, I would focus more on a growth-based investing mindset. But at the end of the day, having a few dividend stocks is definitely not a bad thing. And for that reason, I'm going to put dividend investing right in the B tier, kind of right in the middle of the road. For me, a 25-year-old guy, I don't focus too much on dividend investing. My portfolio is more set up towards growth. But if you're at your older ages in life, or you want to get some more cash flow return, I think dividend investing is a great option to try. Now, next on the list is the Health Savings Account, or HSA, and this one is really underrated. Now, this really isn't a investment that you put your money into to, get rich overnight. It's also not really an investing strategy. It's just an account that you can take advantage of. And basically, a health savings account is an account that you use if you have a high deductible health plan. You put your money in it pre-tax, you invest it, and then use it for qualified medical expenses. Now, the biggest advantage of a health savings account is that the tax treatment you get. You get a tax break going in, right? The money grows tax-free, and the withdrawal for medical expenses are also tax-free. So if you count it up, that's a triple tax advantage, right? Which usually for most accounts is pretty rare. Another big plus is flexibility. You don't lose the money at the end of the year, and once you hit retirement age, you can basically treat it like a traditional retirement account. So if you put money into a health savings account and you never use it for medical expenses, and then you retire, well, at that point, it just turns into a traditional retirement account. Now, the downside with the health savings account, kind of like I mentioned in the beginning, is you need that high deductible health plan. If you don't, you're not going to have access to this, and not everyone is going to be able to get qualified. So you need to be comfortable covering a higher deductible if something happens. Now, me personally, with my job, I do have access to a health savings account, and I do invest some money in there. Well, I actually haven't invested money in there, but I do plan to start doing that at the beginning of 2026. But if you're healthy and eligible, and you can take advantage of that triple tax advantage, health savings accounts are great things to have. And in my opinion, I'm going to put a health savings account right in the A tier. I wouldn't prioritize it over a Roth IRA or a 401k, but it is a great account to fall back on. If you max out your Roth and you're doing really good with your 401k, it's just another, great tax advantage account. Now, next up on the list is going to be cryptocurrency. Now, this is everything excluding Bitcoin. So I'm grouping in everything with this. This is going to include like Ethereum, Solana, XRP, HBAR, and yes, all the meme coins that follow, along with it, right? And a lot of projects in general, right? Apps, networks, whatever it might be. Look, the upside of cryptocurrency is massive, right? Everyone knows this. There's definitely real potential when it comes to cryptocurrency. And some of these crypto projects can grow extremely fast, and overnight you can see 1,000%, 2,000% returns. Another pro with cryptocurrency is innovation. It's all very new, and a lot of people are still trying to figure out how to adopt cryptocurrency. And crypto, in general, pushes new technology forward, and certain projects definitely can have real world advantages to them. Now, there is downsides we need to talk about, and there's definitely a few downsides in general, right? One of the biggest downsides that everyone knows about is volatility. Volatility in the crypto space is extreme. One day you can be up 50%, the next day you can be down 75%, the next day you can be up another 25%. Usually cryptocurrency is all over the place. Prices can swing, basically, when it comes to crypto, you have to know that the money you invest is going to be introduced into a very volatile environment. There's also very massive risks with certain cryptos. A lot of projects fail. Meme coins can die overnight. A lot of stuff can get replaced or just never deliver on what they promise. And just because something is popular, or it's on the news, or a lot of YouTubers are talking about it, doesn't mean it's necessarily a good investment. Now, another thing too is regulation. This has been a whole talking point for the government in 2025, and I'm sure it's going to continue into 2026, where a big talking point is going to be, how do we regulate cryptocurrency? And that's going to drive the price up, or it's going to drive the price down. And look, for most people, crypto outside of Bitcoin should definitely be treated as a high risk, kind of speculative part of your portfolio. Not a foundation, just small position sizes. Look, I definitely own crypto, right? I have HBAR, I have XRP, I have Ethereum, but at the end of the day, it's money that I'm okay to lose. Now, in 2026, I'll be honest, I don't think crypto is going to perform that well. And aside from Bitcoin, other cryptocurrencies kind of as a long-term investment, I don't know how they're going to perform too. It's a very kind of speculative thing. People really don't know how the crypto market's going to look in the next couple of years. Now, for that, I really want to put it in B tier, but especially with how I think 2026 is going to go, I just don't see crypto doing that well in general. And I think for long-term investing, once again, it's really going to take you finding the right project or the right coin to put your money into to see true investments. I think for every, 10 cryptocurrencies that do good, 200 do bad, right? So I'm putting cryptocurrency as a whole in the C tier, once again, excluding Bitcoin. All right, next on the list is going to be the strategy of day trading. Now, if you're not familiar with day trading, this is probably for most people what got you into investing, or at least it's what got me into investing because I was interested seeing people drive Lambos talking about day trading. But it's basically when you buy and sell stocks or other assets within the same day, right? Trying to profit from short-term price movements. Now, look, the upside is obvious, right? You all see the day trading courses. People are selling. They got their Bugattis. They got their mansions. They're in a penthouse in Miami telling you how, just buy my day trading course and you can be like me, right? So we know the upside, right? Fast gains, which attracts people, and it can feel exciting. But the downsides are what everyone needs to talk about when it comes to day trading. The downsides are massive. Most people, let's just be honest, are going to lose money from day trading, especially once you factor in fees, taxes, and emotional decision making. It's extremely stressful and it requires consistent attention. The guys who are out there on YouTube telling you, I day trade and I make an investment in the morning and I come back at night and I make profit, bro, they're lying to you. It shit does not work like that. Day trading makes sense for a very small group of people, usually experienced traders who have very strict rules that they follow, and it's usually meant for the best of the best. Retail traders like you and me, bro, we are not going to get rich overnight day trading. Don't try it. You can do research on it. You can try to gain your skills on it, but it's not a solid investment strategy that I would ever follow, and it's not passive at all, right? I like passive investing. I don't like having to, getting handcuffed on my daily life because I'm watching stocks. So in my opinion, F tier. Day trading is just F tier. If you want to find me out in the comments, if you want to tell me you made $50,000 one day day trading, good for you. But at the end of the day, for the majority of people, long-term investing, just dollar cost average and auto invest. Don't try to day trade it. It's not going to work out. Next on the list is going to be your HYSA or your high yield savings account. Now, this is a savings account that basically just pays you much more money in interest than a traditional bank. I remember the first time I opened my high yield savings account through SoFi Bank, it changed my life because look, when I first opened my high yield savings account, I had like $40,000 cash sitting in a Wells Fargo account that I was making like pennies. Like I was making 4 pennies a month off of. I transferred everything into a high yield savings account and my first interest payout for a month was like $180, which is just, it's insane, right? Now, the biggest pro with a high yield savings account, once again, aside from income, is that you also have safety, right? Your money is FDIC insured, there's no market risk, and you can access your cash very easily. If I need to pull out of my high yield savings account, I just make an instant, transfer and it happens really fast. And that makes this perfect for emergency funds or short-term goals. If you want to get into your, financial career and take care of your finances, I would recommend that if you currently have an emergency fund and it is not in a high yield savings account, pause this video right now, go to SoFi Bank or whatever bank you trust, open a high yield savings account and transfer your money in there to start getting better interest returns on your money. Instantly, it's going to change your finances instantly. Now, another plus is that it keeps your money working for you without having to manage anything. Now, the biggest downside is growth, right? This is not an investment account. This is not something that you're going to put your money into and you're going to be like, oh, I can just skip investing because I have a high yield savings account. It does not work like that. Even if you have a high yield savings account, you need to invest your money at the end of the day because you're usually not going to see returns that you would see from a high yield savings account if you just put your money into something like the S&P 500, right? So it's not for really building wealth, it's for preserving wealth and hedging yourself against inflation. So once again, not an investment strategy, not an investment account, just a great better version of your traditional savings account. Now, in my opinion, if you do not have a high yield savings account, once again, you should be opening one. You should have your emergency fund in there. And when I started using a high yield savings account, it just felt amazing. And I think it's one of the best things that you can do is, once again, especially to hedge your money against inflation and keep your emergency fund safe and consistently growing. Next on the list is going to be lump sum investing. Now, this is different to dollar cost averaging, and there's always a debate which one's better. Basically, lump sum investing is when you take a large amount of money and invest it all at once instead of spreading it out over time. Now, the biggest advantage is that your money gets into the market immediately. And since the market tends to go up over time, over the long run, investing sooner often leads to higher returns. It's also very simple. No schedules, no ongoing decisions. You just invest your money and you let it ride. Now, the downside is timing risk, right? If you invest right before a market drop, it can mentally be tough to handle because now instead of dollar cost averaging, you just put your money into the market and it's gone, right? And this is why this strategy really comes down to your mindset, right? There's always going to be kind of 50-50. There's going to be 50% of people who like dollar cost averaging because it keeps your emotions stable and it lets you buy over time. And there's going to be people who tell you, look, if you got $10,000, instead of dollar cost averaging that $10,000, just drop that $10,000 into the market and don't look at it, right? So at the end of the day, it really comes down to you. Now, once again, this is my tier list. So I'm going to rank this how I see fit. Me personally, once again, I told you guys, I'm self-aware. I'm a very emotional investor. If I dropped $10,000 into the stock market and overnight it went down 5%, I'd feel terrible. Whereas if I just dollar cost averaged $100 a week and I bought in on the highs and I bought in on the lows, me personally, I would feel a lot better. So with that being said, lump sum investing, I'm going to put it in the A tier under dollar cost averaging. Yes, I know over time, there's been statistics that show lump sum investing is better. But once again, for my mindset and my investing strategies, I prefer dollar cost averaging, but by no means should that steer you guys away from lump sum investing. If you have the money and you want to lump sum invest, by all means, go for it because it's a really good strategy to have. Next up on the list is going to be material investing. Now, this is going to be things like Pokemon cards, sports cards, CSGO skins, collectibles, whatever you can think of. This is what I'm grouping all of material investing into. It can even be cars or watches, whatever you want to think it is, right? This is basically when you invest in physical items, hoping they appreciate over time. And the upside is certainly high. I have a buddy that I've worked with, and he's, I think he's big into Pokemon card investing, and he said he's like up 40% this year, which is great. That's outperformed the S&P 500, right? Another plus is enjoyment, right? You're just investing in things that you actually enjoy, right? Like I really like sports. So to me, sports cards are really cool because I'm really into sports and holding value and things like that is pretty cool for me, right? Or if you're really into CSGO, you might be really, into CSGO skins, right? But the downsides are really big because they swing, right? The market is very speculative on these prices, and a lot of it can be driven by hype or, anything like that. And liquidity in these things is very low, right? Selling at the right price is not always going to be easy and it's not always going to be fast. You have to find the right buyer to buy your Pokemon cards. And sometimes that's not the easiest thing. And there's also a conditional risk, one small flaw in your Pokemon card, or if it gets bent or bad storage or, water damage, well, that can significantly ruin the value. So material investing, in my opinion, only works best for people who are already knowledgeable about their subject and treat it kind of as a side play. I would never use Pokemon investing as my core strategy, right? If you want to have 1% of your portfolio or 2% of your portfolio on Pokemon cards, go for it. But at the end of the day, you have to know that there is a lot of unreliability that comes to material investing. And I know there's people out there that have made great money on these things. But for me, in my situation, I don't like to store a lot of my wealth into things like this. So for me, this is going to be C tier as well. I think in 2026 and for the long run, it's just kind of an investment for me. If you like it, that's great. But me, it's not really my type of thing. Next up on the list is going to be meme stonks. Now, meme stonks are the stocks that basically, blow up because of hype or social media, online communities, Reddit posts, whatever it might be. And they're not necessarily strong businesses, right? They're not necessarily good, tried and true businesses that you want to invest your money in. They're more so things you invest your money in because everyone online's talking about it. And the upside is obvious, right? The gains can be absolutely massive on meme stocks, like 2x, 3x your money overnight. And that's typically what pulls a lot of people in. But the downside is that you're basically, it's all speculation at the end of the day. Prices can crash overnight. So you can make all your money up in one night and then in the next hour completely lose all your money. So you have to time it perfectly. And once again, if you guys have watched any investing videos, timing stuff perfectly is not easy to do. It doesn't work like that, right? You can't just say, oh, I'm going to buy a meme stock and sell it at its high. It doesn't work like that. There's also no real edge for your average investor. You're competing against institutions, algorithms, and traders who might just move faster than you or know what they're doing. So if you're an average investor, just stay away from stuff like this. I will give it this, meme stocks can be fun for some people, right? But it's not a strategy. It's not a good strategy to have. It's not something I would want to put any of my money in, to be honest with you guys. Maybe $100 at most if I was really feeling it, but I usually stay away from stuff like this, and pretty much any average investor, normal retail investor, most people in general, just stay away from meme stocks. It's just like day trading. Don't do this. You're going to probably lose your money on it. And yes, you're going to find that video online where some guy's telling you how he made $1 million on GameStop. But bro, that's not going to be you. I hate to break it to you. You are not him. Don't try it. Stay away from meme stocks, F tier. Next up on the list is going to be options. Now, options are basically contracts that give you the right, but not the obligation. They give you the right to buy or sell a stock at a certain price by a certain date. Now, the upside is leverage and flexibility. Options can be used to hedge against risk and generate income, or just make directional bets with less upfront capital. Now, the downside is complexity. I'll be honest with you guys, once again, investing for 2 years, and just like covered calls, I don't really understand options all that well, right? Options move very fast, they expire, and you can lose money very quickly if you don't know exactly what you are doing. So this is definitely not for any average or beginner investor. For most beginners, options seem like gambling because they're chasing quick wins instead of using them strategically. So options can definitely be a powerful tool in the hands of experienced investors, but they are not necessarily for building long-term wealth or something that me personally, I would say any average or beginner investor should start getting into or start investing their money in. So for that reason, options, in my opinion, are C tier. I would not recommend getting into this. And if you do want to get into options, because once again, you see all the success stories online, make sure you do hours upon hours of research before you get your first options contract. Next up is penny stocks. Yes, penny stocks still exist in 2025 and they will exist in 2026. Look, penny stocks are exactly what they sound like, right? They're low-priced stocks, usually very small or unproven companies, and they look cheap, which pulls a lot of people in. Like, oh, I can buy 10,000 shares if I wanted to. Now, the upside is that they can move fast, and if one does hit, the percentage can be very big. But the downside is most penny stocks do fail. These companies often have weak finances, low transparency, and just very real competitive or very low real competitive edge in the market. And they're also heavily driven by hype, manipulation, which means they can be extremely risky for the average investor. Penny stocks often are also speculation, not true investing. So if you mess with them at all, it should be just, once again, kind of like cryptocurrency, money you're okay with losing. Now, at the end of the day, I do think penny stocks, I rate them lower than cryptocurrency. It's not something I would recommend anyone start investing into. Once again, like most things, you're going to see the success stories online. You're going to see those 10 people on a Reddit post saying that they just made, $50,000 last night on a penny stock. But once again, you are not him. This is me telling you that you will not be able to do that. You can try to prove me wrong. I would love for you to prove me wrong. That'd be great for your portfolio. But at the end of the day, I don't think you'll prove me wrong. So penny stocks, not something I'd get into, not something I would recommend you or any average investor getting into. Next up is going to be real estate. Now, most of you guys should know what real estate is, but if you don't, look, real estate is just physical property. It can be a house, it can be an apartment complex, it can be a duplex, it can be an office building. It's just physical property that exists in our world. You either rent it out for cash flow or you flip it for profit, or you hold it for long-term appreciation. Those are kind of the three main strategies that fall under the umbrella of real estate. Now, the biggest upside is leverage, right? You can control a larger asset with relatively little money down, and rental income can help cover the mortgage while the property grows in value. Another big plus is diversification, right? Real estate doesn't really move exactly how the stock market moves, right? It can be up when the stock market's down, and it can be down when the stock market's up. So it can help balance your portfolio out. Now, the downsides are effort and risk. Real estate isn't very passive. You're dealing with tenants, you're dealing with repairs, you're dealing with a building, vacancies, and just unexpected costs over time, which usually require a lot of upfront capital if you want to get into true real estate. And location and timing matter a lot, and bad deals can really wipe out years of your financial progress. Now, at the end of the day, though, real estate is still extremely important for anyone who wants to be a long-term investor. While I do think the house market's crazy right now, while I do think interest rates are crazy right now, I do think for long-term investing, maybe not so much for 2026, but for long-term investing, real estate is, in my opinion, an A-tier investment. I know a lot of people are going to put it S-tier. I get it. At the end of the day, I get it. But for me personally, I'm going to put real estate in the A-tier because I don't know. I just think as someone in my 20s right now, it seems like real estate and owning real estate is something that's getting harder and harder to come by, and, more of a long-term kind of goal rather than something I can be like, oh, I'm going to invest my money in this right now. So A tier for me on real estate. I would love to hear why you think maybe it's not in the A tier. Next up are REITs. Now, if you don't know what REITs are, they're basically real estate investment trusts, right? So REITs let you invest in real estate without actually owning or managing property in a physical form, right? You buy shares and they own things like apartments or office buildings, warehouses, or shopping centers. It's almost like instead of buying gold and silver, you're buying GLD on the stock market, right? It's the same exact thing. And the biggest benefits is simplicity, right? You get exposure to the real estate market and income without dealing with tenants or repairs or what literally all the cons we talked about in the real estate section a minute ago. Now, another plus is dividends. REITs are required to pay out most of their income so they can be, a solid source of cash flow. Now, there is downsides like everything on this list. The downside is you don't get the same leverage or control you would with physical real estate. So you sacrifice the physical real estate to own a digital portion of it. REITs can also move with the stock market, especially in the short term, so you're not in that true 100% real estate market. Taxes are another thing you need to consider when you start investing in REITs because dividends are often taxed as ordinary income in taxable accounts. So you just kind of have to pay attention to that. Overall, in my opinion, REITs are a great kind of middle ground between stocks and real estate, right? It's way cheaper than owning real estate itself, but it also gives you kind of that exposure to the real estate market. So in my opinion, REITs, I put them right in the mid tier, right? I think they're kind of right in the mid tier for most investors. If you want some exposure to the real estate market, I'd highly recommend looking at some REIT videos and kind of seeing, what you could put your money into. Next up is the Roth IRA. Now, this is an account I've talked about countless times. This is probably the most popular investment account for any beginner average investor who is starting out their investing journey. A Roth IRA, in simple terms, is a retirement account where you invest money that's already been taxed. The big benefit is that your investments grow tax-free, and when you withdraw the money in retirement, you don't owe any taxes on the gains themselves. Now, the biggest pro is long-term flexibility. If you're young and expect to earn, more later, locking in today's tax rate can be a huge advantage. You can also withdraw your contributions at any time without penalties, which a lot of people don't realize. Now, you do have to hit certain criteria to do that because obviously if you don't hit those criteria and you try to withdraw your money before retirement, you will be taxed on it and you will be penalized on it. So if you hit certain things, like I think it's like your first time home, if you go to buy a home for the first time, you can withdraw like $10,000 from your Roth IRA penalty free. Now, the downside is the contribution limit. You can only put in so much each year, and there's income limits that can restrict higher earners. So the Roth IRA is just kind of your tried and true heavy hitter retirement account. It's great. It's easy entry. Anyone can open one up. It takes literally 5 minutes. Start investing your money and you got tax-free, kind of gains and returns once you hit retirement. So you're setting your future self up for the win. And for most people in their 20s, 30s, whatever it might be, Roth IRA is just an S tier account. Everyone who's watching this video, if you are into investing, you should have a Roth IRA that you're taking advantage of. Next up is the S&P 500. Now, this is the biggest allocation that I have across my two portfolios. Now, the S&P 500 is an index that tracks the 500 largest publicly traded companies in the US of A. When you invest in it, you're basically betting on the overall US economy to keep performing well. Now, the biggest advantage is the simplicity and the diversification that you get when investing into the S&P 500. One investment in the S&P 500 gives you exposure to literally 500 strong companies. Now, there's been a lot of kind of hate recently surrounding the S&P 500 because people say, well, yes, you get diversification to 500 companies. There's only like 7 companies that hold I think 20% or 25% of the total. So I get that argument, but at the end of the day, you are still getting a lot of diversification when you invest in the S&P 500. Now, the cool thing too is historically, the S&P 500 has delivered solid long-term returns, which is usually why it's kind of the core investment for so many investors. Now, the downside with the S&P 500 is that it's not exciting, right? You're not really picking winners, so you're not really going to outperform the market. The S&P 500 typically is the market, right? So you are the market. At the end of the day, if the market goes up 20%, you're going to go up 20%. Now, once again, the downside is if there's a stock within the S&P 500 that goes up 50%, well, you're not going to get full exposure to that 50% return. Now, it also comes with market risk, right? When the market drops, once again, the S&P 500 is the market. So if the market drops, well, your money is dropping, too. So for long-term investors who want steady growth without complexity, without stress, without anxiety, I still think the S&P 500 is the best allocation that you can have in your retirement account. I know a lot of people are going to say, oh, the US economy is not doing good right now and X, Y, and Z, and the Mag 7 holds the majority. I get all those arguments. I still think at the end of the day, I'm willing to bet on the US economy to keep going up in the next 20, 30, 40 years. Next up is saving your money only. And I'm talking about investing it. I'm literally talking about only saving your money. I'm counting this as a strategy. Now, the reason I'm adding this on here is because if you're a beginner watching this video, when I first got into investing, I literally thought that I was doing the right thing by just saving my money, right? Like if I have cash on hand, I'm doing good. But the problem is, no matter what country you live in, usually your dollars depreciate over time. Things get more expensive, inflation exists, and your money goes down. So by only saving your money, I know it sounds weird, but you're actually losing your money pretty much on a daily basis. And now there is pros to this, right? The biggest pro is you're going to feel secure. You're always going to know where your money is. You're always going to see your money in one big account. You'll be like, yeah, I got money. But at the end of the day, the downside is inflation is going to eat away at your purchasing power, and your money is technically losing value even though the number stays the same. So savings alone, just saving your money alone, will never build you wealth. I thought it did, but it doesn't, right? It's a great foundation, right? Don't get me wrong. It's always good to have cash, and it's always good to have a strong foundation of just a cash position, but it's not a strategy, right? So saving money is great for emergencies, great for short-term goals. And once again, if you're going to save money, throw it in that high-yield savings account. But you need to go beyond this, right? You need to expand upon this when it comes to investing your money. So with that being said, I'm going to put saving only in the C tier because I know, especially when a lot of people get scared of a market crash, they pull out their money and they put it in a savings account. But once again, you need to keep your money in the market. You need to keep it rolling for you. So make sure you do not only just save your money and you actually invest your money. Next up is individual stock picking. But let me say this. I know some people might be confused because I have day trading and then I have meme stocks and I have individual stock picking. What I mean by individual stock picking is long-term individual stock picking. So like if you want to buy Google and hold Google for the next 5 to 10 years, or if you want to buy Nvidia and hold Nvidia for the next 5 to 10 years, that's kind of what I'm talking about in this category. Now, the upside with individual stock picking is upside, right? If you pick a great company early on, the returns can destroy, like you can just beat out the market. You can beat everyone and their moms in the market if you pick the right company at an early enough time. You also get more control, right? And can focus on businesses you actually understand and believe in. For example, for me, my biggest individual stock allocation is towards Google. I think Google has a great company. I believe in them for the long-term future. I trust in YouTube. I trust in Waymo. I trust in Google AdSense. And I think the company will continue to perform. So I have a decent allocation of my portfolio to specifically Google themselves because I want all that individual exposure. Now, the downside with individual stock picking is risk and consistency. Most people who individual stock pick underperform the market because it's hard to pick winners over long periods of time. There's also just so many damn options. You can find 500 companies that you think might perform well, but I wouldn't recommend having a portfolio of 500 companies, right? Like I would try to narrow it down to like 5 or 6 companies you really like. It also takes time and research and just emotional discipline, right? Because here's the thing. If Google drops 10%, well, the S&P 500 probably drops 3%. So you start telling yourself like, why did I do this? And it gets very emotional individual stock picking. So I would go into it with, with time and research before you actually start picking certain stocks. And I would not invest into a stock that you don't understand the business model or what direction the business is going. So stock picking can work, especially if you're disciplined and have that long-term focus, but it's not necessary to build wealth. So if you're going to get into individual stock picking, my advice is do research on the company. Take your time, understand what direction the company's going, what fundamentals they have, who the CEO is, and if you like that company. And for the majority of retail investors, going with something like the S&P 500 will outperform individual stock picking and will just be less stressful and less anxiety causing than picking certain stocks and having to deal with more red days or bigger drawbacks. But at the end of the day, I do think stock picking, if you know what you're doing, is kind of a mid-tier thing to do, right? I like I said, for most people, the S&P 500 is going to win, but if you know what you're doing, I think individual stock picking obviously is very profitable. Next on the list is target date funds. Now, if you have a 401k, there's probably a 90% chance that you are invested in a target date fund and you didn't realize it. Target date funds are basically all-in-one investment funds that automatically adjust themselves over time based on the target retirement year. So for example, I'm 25, which means I was born in 2000, which means my target investment year is 2065. Now, for example, if you invest in a 2065 target date fund, that means they're going to kind of project you to see decent returns and be competitive and taper the investments for you as you get older until you are able to pull out those investments. And the biggest, kind of benefit of a target date fund is just the overall simplicity, right? You don't have to rebalance. You don't have to pick funds. You don't have to think about asset allocation. It's literally all handled for you. You just put your money in it and everything else is done for you. The downside is the exact opposite of the upside. There's no real control in a target date fund. So you're locked into whatever strategy that fund is choosing for you. And some target date funds come with higher fees than kind of building your own, 3-fund or 2-fund portfolio in your own investment account. Target date funds are also great for beginners or anyone who just want to set it and forget it approach. So kind of at the end of the day with a target date fund, it's all kind of up to your investment strategy like everything on this list is. If you're okay with very conservative, low stress, do it all for you investments, target date funds might be S tier for you. But if you don't like conservative and you want to, the most growth on your money, and you want to be in control of everything, it might be F tier for you. So for me, target date funds, once again, right in the middle, right at that B tier strategy. I think for most people, target date funds kind of are the bare minimum you should be invested in, and then kind of expand from there. Next up are technology ETFs. Now, what I specifically mean are like things like VGT, right? Things like software, hardware, AI, or just big name tech stocks all in one ETF. Now, the biggest upside is growth. Tech has been, over the recent time, one of the strongest performing sectors over the long run, driven by just innovation, AI, scalability, everything, right? I mean, we see how much tech has advanced from 2000 to now, or from 2010 till now. It's insane, right? Another benefit is diversification with specifically tech ETFs, because since it's an ETF, you're buying more than one stock at a time. So you're not just betting on one company, you're spreading that risk across the entire technology sector. Now, as most of these, the downside is the exact opposite of the upside, is now you're concentrated into only technology. So technology, as you've seen if you pay attention to the stock market, can be extremely volatile. And when the sector underperforms, well, those funds can drop sometimes 5, 10, 15%. So you're also doubling down on one part of the market, which means overall less diversification. So even though you're spreading your risk across tech stocks, at the end of the day, they're still tech stocks. So you're losing some of that diversity that you'd see in the S&P 500. So overall, in my opinion, for 2026 and just the foreseeable future, I do think tech ETFs, once again, something like VGT, will still be a consistent performer. It's still something that I invest a decent amount of my portfolio into. And I still think at the end of the day, tech has a long way to go with innovation and just new technology coming out. And for that reason, I'm going to put tech sector ETFs in the A tier. Next up is the total world index. So imagine the S&P 500 on steroids, right? The total world index basically invests in thousands of companies, not just in the USA, in the entire world, right? In just one fund, right? So the biggest benefit here, in the name of the game, is diversification. I mean, you're diversified in literally the entire world. I mean, you can't ask for more diversification than that, right? So you're not just betting on the USA, you're not just betting on one country, you're not just betting on one economy, you're not just betting on one company. You are literally betting on the whole world to continue to perform decently, right? So it's also extremely simple, right? One fund gives you global exposure without having to manage multiple ETFs, right? So if you just want the broadest, most diversified exposure, this is the fund for you. Now, as everything, there is a downside. The downside is that it can slightly underperform the US market during long stretches where America is leading. It's no secret that most of the time America does lead in economy performance, and times where, some other economies aren't doing as good, if you're invested in the total world, kind of index, you might lose out on some of those S&P 500 gains. But if you want kind of a true, kind of set it and forget it approach with just maximum diversification, this one is extremely hard to beat. Now, in my opinion, I'm going to put it under the S&P 500, but still in the S tier. I would still, me personally, invest my money in the S&P 500, but I do think this is one of the best investments you can have if you want true diversification over the entire world, pretty much. Next up is Bitcoin. Now, I separated Bitcoin from cryptocurrency in general because I do think Bitcoin is the best and the only crypto that if you want to get into crypto, just start with Bitcoin. That's what I'd recommend. Don't worry about anything else. Start with Bitcoin. It's the easiest starting point. It makes the most sense, and it's kind of the least to fail in my opinion. Now, if you kind of don't understand Bitcoin, I'll keep it simple, right? It's basically a decentralized digital asset with a fixed supply of 21 million coins. There will never be more than 21 million coins of Bitcoin. And there's no company behind it. There's no economy behind it. There's no one controlling Bitcoin. It is literally an algorithm, right? And the biggest upside, just like gold, that's why they call it digital gold, is scarcity, right? The supply is limited, and many people see Bitcoin as a hedge against inflation and current, kind of devaluation of our dollar bills. It's also completely global and independent. So you can hold it yourself. You can actually own it, especially if you own the keys to it, right? You can actually own it, and you can move it across borders, and no one can dilute your supplies. Now, the downside with Bitcoin, just like most cryptocurrencies, is volatility. Bitcoin can swing very hard in both directions. I mean, I'm sure you've seen the days where Bitcoin's up 8%, and I'm sure you've seen the days where it's down 8%. And that can be tough to stomach if you're not prepared. It also doesn't really produce cash flow. Bitcoin, in my opinion, is a growth-based investment. You're not going to earn income from it. It's going to be growth. There's no dividends. There's no quarterly payouts, none of that. It's just pure growth and pure hedge against inflation, right? So its value comes from the adoption and the belief in the network and kind of the belief that the dollar bill or whatever currency you believe in is going to go down over time. Now, Bitcoin works best as a long-term small allocation for people who understand the risk and can be, and kind of can hold Bitcoin through volatility, right? If you plan to use Bitcoin as a day trading thing or as something that you're going to hold for a year, I probably wouldn't recommend getting into it. I would only recommend Bitcoin if you're going to plan to hold it for the next 10, 20, 30 years, which I plan to do, right? Now, at the end of the day, I'm a Bitcoin believer. I do believe in it. I will say this though, before all you Bitcoin demons come after me, look, I love Bitcoin, but I will say I do think the years of seeing 40 to 50% kind of gains on Bitcoin are over. I think the more it gets adopted and the more people who start to use it, I still think it's a great hedge against inflation. I still think it's great for growth. I still think it's great to allocate some of your portfolio to it. But I do think the years of 40% returns, 50% returns are probably over. I would expect more of like 10 to 20% returns for the next, 10 to 20 years. But that's still amazing return on your money. So for that reason, Bitcoin is an A tier investment for me. It used to be S tier. I still invest into it. I still dollar cost average every day into it. But for 2026 in the future, I'm dropping it into A tier. Next on the list is precious metals. Now, I specifically left this one for last because if you guys have not been paying attention, gold and specifically silver have just kicked everyone's teeth in this year. Like, I think silver might be one of the best performing assets in 2025. I think it's up 101%, 110% year to date. Insane numbers from gold and silver this year. Like, if you started this year and you put $10,000 into gold and silver, I mean, I wish I was you. You're just a rich man. You know what you're doing. You're a better investor than me. But aside from the jokes, let me be honest about precious metals. I do think precious metals, a lot of people need to temper their expectations and zoom out on precious metals. Because while, yes, they have kicked everyone's ass in 2025, if you zoom out, precious metals are not supposed to perform like this. It is not normal to see gold up 50%, year to date, silver up 100% year to date. It is not normal to see those types of returns. The biggest benefit, the reason people invest into precious metals is stability. Gold especially tends to hold value, not necessarily gain value, but hold value over long periods of time and can perform well when markets are stressed, which we saw stressed markets all through 2025, which is why gold continued to do so well. Now, the downside is growth. Typically, precious metals don't produce income, they don't compound like traditional stocks, and over the long run, they usually actually underperform stocks. So, my opinion and my kind of advice to you guys is if you want to invest into gold and silver, I still think it's a great investment. I still think for most people, precious metals are a really good investment to specifically hold value and hedge against inflation. Do I think we're going to see another year where gold is up 110% year to date? Or sorry, silver's up 101 or 110 year to date? No. I do not think that's going to happen again. Do I think we're going to see another year where gold is up 40, 50%? No. Do I still think they're good investments? Yes. So if you are kind of late, like for example, I'm very late to the precious metals thing, right? I didn't own any gold. I didn't own any silver at all at the beginning of this year. And I wish I did. But it's very easy to FOMO into these things because we see the current returns they're offering, but just temper your expectations, right? I would not go into buying gold and silver right now expecting to double my money because traditionally, once again, zooming out, that's not how gold and silver are meant to perform. So I would not take 1 year and base my future investments off of that. Now, aside from all the yapping here, precious metals for me, I think it's a B tier investment. I do think it's, once again, it's a good place to store some value. It's a good place to get a little bit of growth, but just don't invest into silver again expecting to double your money in 1 year, right? The likelihood of that happening is probably pretty low. So that is my tier list for 2026 and for long-term investing. This is the new updated investing tier list. I appreciate you guys for watching. Look, I'm not a financial advisor by any means, but I do love talking about this stuff. I hope you guys found this educational. Let me know what you agree with. Let me know what you disagree with. And let me know what you think are going to be the best performing assets of 2026. I'd love to hear your opinions in the comments below. But I appreciate you guys for watching this video. I hope to see you guys in the next one. Like and subscribe, and I'll catch you guys later. Have a good day, have a good 2026, and have a happy holidays with your family.